Welcome to the Money to the Masses podcast, putting you in control of your finances. One mic, two idiots, and, according to our latest figures, 3 listeners. Here are your hosts, Damien Fay and Andy Leeks.
Hello and welcome to episode 102 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How you doing?
I'm good, Andy. It's good to be back. How was your week?
Yeah, one of those weeks where nothing really... Actually, I shouldn't say that. My wife had a birthday. We had a birthday in the household. But it's one of those things, we were all very busy. I was working, she was working, so we haven't strictly celebrated it yet. So we're going to do it at the weekend. So other than that, not much to report. So what about you?
Nothing sort of personal that's too exciting that I've been up to. Watching the mighty Spurs as usual. And from Money to the Masses angle, a couple of things have been interesting. I'm starting a new project, a podcast-related project, which I'll reveal more in the coming months as it takes shape and takes form, which people who listen to our podcast, Andy, will be interested in. So that's exciting, and it's taken a bit of work, but it's in the background, so I won't tell any more about that, but until it formulates a bit more. But it will be interesting, and people will like it. What else I've been up to? Started doing a bit of video. We talked about video that we were playing with YouTube not long ago, and that's evolving, because something that struck me is that I do a lot of the newsletter, Money to the Masses newsletter does a lot of the personal finance news, so it gives people the stuff that they should be concerned about or should be reading about every week on a Sunday, which you can sign up to by going to moneytothemasses.com. And we're evergreen on the podcast, aren't we? And we have different products like 80/20 Investor, our DIY investment service that teaches people how to invest, and our newsletter pulls that together, but pulls in stories from the rest of the internet. And one of the things that struck me is that via our social media channels, I do a lot of commentary and bring up lots of that together. But I've started pulling together via Instagram in particular, what do you call them? Memes, pictures with words. You know, those things where, but with headlines. The headlines are important under the hashtag MTTM Roundup. So an abbreviation of Money to the Masses Roundup. So that's on Twitter, Facebook and Instagram. So every day I'm doing that. I'm pulling them together. So basically a picture. It paints 1,000 words and it just gives you the 3 things you need to be worried about that day. So I do that every day now. And that's proving quite popular. And one thing that is evolved out of that, I've not really mentioned this before. So if you want to get a daily dose of new stuff, just a quick glimpse of what you need to be worried about headlines, and you can carry on your merry way, then do follow me on Twitter, Facebook and Instagram, or any one of those, because it appears on each. I've now decided to start doing video that gives a bit more insight into those headlines at the end of a week, and we'll see how this goes and whether it stays. But I've just done the first ones today, and we're going to do them in the coming week. So I give a bit of insight, talk about the key stories of the week and a bit of insight behind those headlines, any tips or my thoughts in a video that's going to be no more than a couple of minutes long. So it's quite tricky to do, but again, it's just another way of getting money to people, contemporary money stuff to people, but in our usual informal way. So have a look at that. We've got our YouTube channel. You can find it via obviously YouTube or our website. So in the coming weeks, that's going to evolve. So keep an eye. And that's quite exciting. So that's what I've been up to this week. And the other thing, I'm inspired by something we were talking about last week. Do you remember the Sky story, the Sky man who came around? I did a piece on things I shouldn't be telling you based on a Sky engineer who told me something he shouldn't have done.
Yeah.
And one of the things in there was about asset allocation when you invest, and how you can get insight from other places. Well, I'm going to build, or have been building, a tool in the background to do that for you. Because it was very good. It's all well and good talking about it and saying that this is the trick you can do to get a bit of insight about where you should invest. But I'm now exploring that and building something, and will probably invest in getting that built as a tool. So it's a watch this space. And I bring it up just to emphasise how this stuff evolves, and it's not just me wittering on. I do take this stuff and run with it.
Good. Busy week then. Right, so I suppose that moves us on to what's coming up in this very pod. Lots going on in the background. What are we talking about today?
Right, today I'm going to do some interesting pieces, slightly philosophical, one or two of them. I've been asked the question about the most important thing people should do to improve their financial well-being. And so this is the gem, one of the crown jewels, as it were, that somebody's asked me. And I'll explain why in a second. And I'm going to cover that. And so it's one that's worth listening to. I'm also going to answer a question relating to investing that somebody has brought up. Actually, it was an 80/20 investor member wrote to me and said this would be a good topic for the podcast. And it is, probably in more ways than he realises. So I'm going to go with that. It's worth listening to. It's about how you know where to invest and that kind of low risk versus high risk asset allocation and how things have changed. So that's worth listening to. And two pieces I'm going to try and squeeze in. One, which is a bit of hope for first time buyers and 100% mortgages, and just a quick message on financial fraud, and in particular something called transfer fraud.
Okay, good. Lots coming up then. I quite like the idea of getting all philosophical at the front end. I've been looking at the philosophy of happiness, and so it kind of ties in quite well with what you're talking about financial well-being and the philosophy of it. So should we go with that one?
We'll go with that one, Andy, because I'm like you. I like to read around the kind of well-being stuff, and there's some fantastic books. If anybody wants to know, tweet me and I'll share some of the ones I've read that are around that, but not money related, that relate to just, like you say, happiness and well-being. And there is an overlap if you look, or maybe the word's an application of some of that stuff to money if you think and try hard enough. Now, I was asked as part of what is now going to be called International Podcast Day, which is, I think, in the next week or so. And another podcast, one that I've been interviewed on before, got in touch and asked me what is the most important thing people should do to improve their financial well-being. And they wanted me to do a bit of a snippet. And it got me thinking about what is the thing. So it's like a blank, almost like a blank canvas on which to throw that out. And that's quite a it might seem a tricky or big question on the face of it. Now, I could sit there and come up with, like a lot of people probably might do who deal with money, something about debts or some clever financial trick they should be doing, or do you know what I mean, or investing.
Yeah.
And I got philosophical, as you said, Andy. And part of that came about, the spark came from earlier on today, in fact. My daughter came up, as she does in the mornings at a ridiculous time, and woke us up and ready for the day. And we were chatting about, I don't know how we got onto it, we started talking about age. And she asked, why do old people get wrinkly? So when you're old, why do you get wrinkly? And of course, it's a very difficult thing really to try and explain to a 6-year-old, but it pretty much came down to like the passage of time. And that idea it stuck with me for the rest of the day when I started pondering this stuff. And my tip to improve their financial well-being, or anybody's, is to build a default plan. Now hang on to that time thing I just mentioned, because I'm going to come on to it. My tip is to build a default plan, okay? By that I mean that if all else fails, the default will kick in, and by pure default, you're going to end up at a certain destination. Does that make sense?
Okay, yeah.
So, I mean, it's a bit like if you went on a bus, if you fall asleep, you're going to get to your eventual destination, or you get a taxi. Do you know what I mean? You're not having to do anything. You're in transition, and that's kind of, you're going there, the default, if that makes sense. So, I'm always a big fan of building defaults in life, whether it's a career plan or anything to do with money or my own life or whatever. So that it's like a fallback. So the idea behind it, when I sort of sat down and thought about it, I was trying to explain this, is actually the crux of all this financial well-being is to try and turn any solution to a problem you've got that's related to money. Normally that solution relates to pounds and pence, doesn't it? It means money. So if you've got debts, it means you need more money. Or if you want to invest or retire, it means something to do with money.
Yeah.
It's actually to try and change it into a function of time rather than money. So now you get where I was going with that story of my 6-year-old coming in and we were chatting about age and stuff like that. Because the most powerful, not to get all Brian Cox about it, but I remember watching one of his programs, the one force in the universe which we can't control that will happen no matter what is time, okay? So we are going to go travel forward in time no matter what happens. Other things like direction, all these things we can stop. But time, we can't. So the idea behind my philosophical answer to that question, which will probably surprise them because I'm not going to give something that's very practical, well, it is in a way practical, but not the way they envisage, is to turn any problem and financial issue you've got, the solution, turn it into a function of time. So I'm going to give you a couple of examples. A good one is debt, okay? So let's say you've got a load of debt. Now, the issue you've got is you need to pay off that debt, and you need money to do it, and it seems like a mountain, an Everest that you've got to climb, and you don't know how to do it, how you're going to acquire it, or something like that. So a good example, which I've touched upon, I think I may have touched upon it in a podcast previously about debt, but it's worth pulling out and talking about it a bit more today, is that the average person in the UK has a debt of £2,346. Apparently, that is the average debt. And the typical APR on a credit card debt of that size is 18% a year. That's a lot. And then the minimum payment you have to pay. You know, when you get a credit card, you pay the minimum each month.
Yeah.
And you shouldn't do that, because if you pay the minimum, it would actually take you over 25 years to clear that debt, only paying off the minimum. Because you pay the minimum and then they add interest again. And you're just chipping away ever so slightly, aren't you? Because if you think of 1%, let's say that's 60 quid. 60 quid doesn't come off your bill, because that actually a large chunk of that £60 is new interest. So you're only probably chipping away £10, £20 or something like that. That makes sense?
Yeah.
Now, obviously, you've got to pay more than the minimum, because then that actually means that you're chipping away more. One of the tricks is actually to, rather than pay more, if given that size debt, that minimum probably is around about £60 a month. As your debt, what would normally happen, as you start chipping away at that debt, paying that minimum, then the debt gets smaller and then your payment starts to reduce. So it's kind of one of those things you never get to the finish line. If instead you took the £60 you're paying this month and wrote to your credit card company, so I'm going to pay a fixed amount of £60 a month, don't rack up any more debt. As your debt starts to reduce, your monthly payment is fixed, okay? So you start to accelerate the speed at which you pay it off. Now, to emphasise the speed, I said there was 25 years if you did it on minimum payments, where you started at £60, as your debt reduces, that minimum payment reduces. If you said, no, I can afford £60, I'm not going to pay any more, can't afford any more, let's go with that £60, you did that until the debt was paid off. In 4 years and 5 months, that debt would be gone. So what you've done effectively is you're not changed really the amount you're paying, because you're still doing that £60, although it's fixed. You've kind of turned the problem into a function of the fact that, do you know what, if I just stick at doing this one thing, this problem will go away. You're not having to pay more. You're not having to turn it into a pound and pence problem of trying to acquire more money. You've just turned it into a function of time. Because the first one where you're paying the minimum, it's almost like infinity. 25 years, you might as well just say 100, because you're going to, do you know what I mean? Your circumstances will change and it will get bigger and bigger or whatever. So mortgages are another good example of this. Anyone who has a mortgage, do you remember there were the days gone by where you could get interest only or repayment? Now, I always went for a repayment mortgage when I took mine out. And the reason I did it is because, again, when I thought about it, it really is me turning the problem of owning a house into a function of time rather than money. Because if you had an interest-only mortgage, which lots of people still do, although you can't get them readily anymore, there's lots of people who are still on them. What you're going to have to do is either sell your house if you can't pay that lump sum at the end, because you've not paid back any of the money you've borrowed, you've just been paying the interest, hence the name, or you're going to have to find a few £100,000 at the point when that mortgage was due up, say 20 years' time when you want to retire. Again, that's a problem of pound and pence. A repayment mortgage actually then makes it the solution becomes a function of time. Because if you just live in your house for 25 years and keep paying your mortgage, yes, it's a little bit more than what you would be paying on interest only, but by time you end up solving the problem. So this is that default plan. Do you know what? As long as I can just keep my head above water, I will end up owning my house. And negative equity, again, that whole repayment mortgage will get you out of negative equity. If I just bide my time, my house will end up rising in value, or I've paid off more of my debt to get me back into positive equity. Does that make sense?
Absolutely, yeah.
So the point of the financial well-being is, I could say to people, because it's about well-being and happiness, stop worrying about your money. That's the key. But that you're not going to do that if you haven't got a solution. And so if you think in each of those cases, you haven't fundamentally acquired more money. All you've done is got a plan, a default plan, whereby, do you know what, if I can't afford to pay more off my debt, if I can't afford to overpay my mortgage, my new plan, if I just do this, after this amount of time, the problem will be gone. And it's the same with investing and retiring, because you can apply the same logic. And what people will do is they think, I want to retire, how am I going to achieve that? Again, you can do it by a function of time. The earlier you start saving, the lower you have to pay. So it starts reducing the monetary problem. But it's not just about starting earlier, because if you're 40, you can't suddenly decide, I wish I'd started saving at 25. But you can then save at the level you can today, but then build a plan that you're going to try and increase marginally year after year. Because don't forget, if you were to increase your contributions by 7%, say, every year, that's not a lot. Then in 10 years, you'd be paying twice as much into your pension you were before. And and then that becomes, again, if that's your plan, you know that all I've got to get is that small amount of increase every year. You start again to bring it back into a function of time. And I just want to finish on this piece, really, because I also apply it to careers and pay rises. Because one of the things that I did, one of the reasons I ended up in finance, and this just shows you the kind of character that I am, I always got frustrated about in life that, I don't want to swear, but the bullshitters in life seem to get further, don't they? The people who go into offices and start giving it the big I am and are really bullshit and aggressive get to further up the chain just by that sheer will. And sometimes you think that shouldn't be the way life works, but unfortunately it does. And it just felt to me, unless you can compete with that, then you would be stuck behind. So again, how could you turn your career into a function of time? So what I used to do was I decided and ended up in a career where I thought, I need a career where if you take qualifications, the more you take, the more you get paid. Because in finance is a brilliant example. If you hold certain qualifications, they start becoming almost the minimum you will be paid. You can move jobs, like lots of jobs have it. You have to have this qualification to get paid a certain amount. Teaching's an example. If you want to go from being, say, a nursery nurse teacher to a fully fledged, like the next year up in a school, you end up having to have a degree and things like that. Do you know what I mean? That then gives you a benchmark of where you can get paid. It's not just rigid industries like finance. So what I did, I'm not saying this is the perfect way, it's just the way I found it worked for me, is I developed a default route where I thought, do you know what? If I decide to study this set of exams, do this number every year, by the time I'm 5-10 years down the line, I'll either be completely qualified at this, or at least my salary would have risen, or I've moved into something else because I would have notched up my worth, because they can't, once you've got a certain degree, a certain qualification, they can't take it away and they have to pay you that. So really all I was doing, I didn't realise it at the time, but when you look back on it, I was trying to turn things into a function of time somewhere along the line. So this is my financial well-being thing, because then if you get your life and your money where it is a function like that and there's a default plan, you don't worry about it, do you? Because there's something that's gonna, the default is good. Anything you do above that can only be better. Yeah. So if it all goes wrong, then the default, like if I'd lost my job, well, the default was I was going to keep doing those qualifications, and I would eventually got a job qualified somewhere else. Or at least you'd hope I would have done. Or you'd end up starting up your own website, doing money to the masses and talking to you, Andy, on a podcast. But, do you know what I mean? My default option actually was I would have been an actuary or some form of, that was where I started. And I deviated from that. I changed what my default plan was as I saw fit. But again, it was trying to turn things into a function of time. So my tip to anybody, whatever your problem, think, is there a default plan you can create that just sets the wheels in motion, that you will actually achieve what it is you want by longevity, by just sticking at something? And if you can make that default plan, so the time is the overriding factor, so it's like starting saving earlier or whatever, then it reduces the monetary value or monetary element to the solving the problem. So there you go. My philosophical start to this podcast.
Okay, so for the next part of the pod, we're going to be covering investing, and you've had a question from one of your 80/20 members, and I think they suggested that it might work well for the pod. Well, it does, and here it is. Damien.
It does, Andy. The idea, I'm going to read the question out, or attempt to read it, and just go with it. The question...
Should we say at this point to our listeners that I've already tried to read it and couldn't, so we've had to switch it around?
Well, that's why I've said that, because we'll be here all day, because I'm going to do the same thing, and I'm just making an excuse for me messing up and fumbling over my words. So the question is, I seem to remember a suggested formula of how much of your wealth to divide between equity and safe investments, i.e. cash savings. Something like a percentage lined to your age. I think it means aligned to your age, i.e. the older you are, the more you keep safe. Sorry, I don't have the actual formula anymore, but it was something like if you are 50 years old, you would keep half in both, i.e. safe and equity. My argument is, now that cash returns are so low, careful investing in equities can potentially far outweigh the risks that was associated when the idea first came about. How would we reappraise the formula? I hope the idea is of use. Phil?
Do you know what? I read that question 3 or 4 times in my head and couldn't quite get it. As soon as you read it, I understood the question. So fingers crossed the listeners will have too.
But in fairness, Andy, I have had this question for a couple of days when I was thinking about putting it on the pod. So I've read it numerous times. So I just threw it at you and, oh, here, Andy, here's the question. And you were chucked in at the deep end. And it's lucky the podcast isn't live, isn't it? Because that was my... I shouldn't have done that to you. Right. What they're getting at here is in a previous podcast, I talk about something called the age guide, about how you might want to invest your money. This whole thing about asset allocation. How much of your money do you put in safe stuff? How much do you put in more risky stuff like equities? And the formula is like I say, it's a rule of thumb that shouldn't be necessarily overly relied upon. It's a good starting point, and professional investors do use it, whether they admit it or not. I know they do. I've been in meetings where they've talked about it, and the idea is that if you take your age away from 100, then that will give you the amount that you should have in the more risky stuff and your age in the safer stuff. So, for example, let's just say you're 40 years old. That means you should have 40% in the low risk stuff and 60% in the high risk stuff. Okay? So as you get older, if you were 60, it'd be the other way around, wouldn't it? You'd be 60% low, 40% towards the medium and high. Now, Phil actually raises a really interesting point, because I don't know when this idea ever came about the age guide, but what he actually has hit the nail on the head about is how risk has changed and your expectations of what you get from that risk has changed. Now, Phil mentions cash at one end, and it isn't just about the low risk stuff. Isn't just cash. You've got to think about it on a scale where one end is equities, the other end is cash. In between, you go from cash, you go to cash-like peer-to-peer lending. You then move up to things like bonds, retail bonds, bond funds. Then you sort of start moving up towards... You probably have property before those as well, like bricks and mortar down that end. Then you start moving up to things that are getting more like shares and funds that invest in shares, and all the way up the top, and you get to like currencies, etc., etc. So you can see the sort of the spectrum. The low risk stuff is like, where do you draw the line on that? Is it at cash? Is it slightly further up? And what's actually happened is that this is a consequence of QE. You know that money printing I talk about? Yeah, I always talk about this, the watering of the garden when I talk about central banks. Do you remember, Andy?
I do indeed. I'll never forget it.
When central banks start printing lots of money or reduce interest rates to boost the economy, what happens is it's like sprinkling a parched garden. The water will just run across the surface rather than soak in. They want it to soak in, but it doesn't. So what happens... that's like what would happen if you got your hose onto your garden and it was parched. That's what happens with the economy. If you spray money on it, whether it's by printing money or interest rates, it doesn't sink into the economy and boost it uniformly. What happens is it actually starts to distort things, and it runs off and it finds its way into riskier assets like shares. That's an unintended consequence. Some of the money will seep in, but that's an unintended consequence. The other thing is, when they cut interest rates, they don't want you... The Bank of England doesn't want you to sit on piles of money in your bank account. They don't. They don't tell you that, but that's why they do it as well. Because if you get hardly anything in the bank, you're going to want to take that money out and spend it, aren't you? You're going to want to go and buy stuff because you're going to probably make more money, or you're thinking, look, it's getting nothing in the bank. What am I doing? I might as well enjoy it. And so it encourages people to start spending money. Companies, it does the same thing for them. Now, of course, what happens is that some people think, well, I want to earn some money from this rather than spend it. So they start moving up that risk line. So the cash doesn't give you anything. So they move up and start going further up it to try and get a return. And as Phil suggests, equities is right up that curve. And people start investing in that because it's the only thing that's going to give them a decent return long term. The thing is, what's also happened is because the way this money printing works, we won't get into the detail, that the Bank of England buys all the really low risk stuff, what they call government bonds and stuff like that. So it actually pushes down the return you're going to get on that stuff. You know what I mean? It does in the long run. So it distorts the market. So what actually happens, all the other risk stuff you get in the world is almost priced off the lowest risk stuff. It's almost relative. Does that make sense?
Yeah.
To give you a real life example, if you talk about the mountain, Mount Everest, yeah, okay, is the mountain with the highest altitude. So it's like people say it's the tallest mountain in the world. The fact is that Mount Everest isn't the highest point on planet Earth, okay, because it's relative, because we take the altitude relative to sea level. But there is a mountain, I think it's in, I have to look it up. Actually, I'm going to do it now. I did look it up for the pod. There is a mountain somewhere else, people can look it up, that is actually higher. And I think it is in somewhere like, I think it's in South America somewhere. But the point is, it is further from the tip of it, is further from the centre of the Earth. So it actually is the highest point on the whole of the planet Earth. So that's the whole point about being relative. What the Bank of England and all the central banks did by printing money is they kind of shifted sea level. And so, do you know what I mean? In an investment world, they shifted that relative risk level. So what happened, low risk stuff actually started behaving in a quite risky way, because one second they'll go into the market and buy it all up, the next minute they won't. Suddenly the demand and supply metrics have gone really crazy. It's like if suddenly loads of people buying houses in your street, the price would shoot up. If they all suddenly stopped buying, the price would drop. And of course, what's happened is the low risk stuff is now shifting and becoming higher risk, but you're not getting as much return. And so people are moving up the spectrum. What Phil's pulled out is, with 80/20 Investor, one of the things I do is I ignore the assets that the funds invest in and the sectors, and I just look at all the funds and almost line them up and see how they're behaving in terms of risk. And no one else does that. People do it in like strict categories, like these are property, these are UK equities. But I don't. I ignore that to try and see how they move and how that risk level moves, and then try and assign low, medium and high risk labels to them based on how they behave to each other. And what I've seen, and this is a bit of a, what's the word, insight that I've not said before, that since I started 80/20 Investor at the very, very start, the range of things that were low risk was very different. There was a broader spectrum, and as we've had more QE and we've had various different instances like Brexit and things that have started to distort the market because central banks are playing with them, then the things that were traditionally low risk, what would define them that way, would no longer be in there. They'd move up and be more like medium risk, and equally the medium risk stuff will start to move up to high. So what you have to do is readjust your scale, and cash just gets left behind at the very, very bottom, if that makes sense.
Yeah.
And so that's what Phil is saying. So in answer to Phil's question, the age guide still is relevant, but the things that are classed as low, medium and high might be slightly different to what you had before. So it isn't just cash, it might extend up to some of the other things that have taken a little bit more risk that were perhaps 5-10 years ago more medium risk. So you might have the low risk stuff start to incorporate some types of odd equity exposure, very, very minor. Of course, 80/20 Investor does this for you, and it's a brilliant question because it pulls out this idea that as the risk levels increase in the world, that actually impacts how 80/20 looks at things, because it's got to be relative. Today's world is not the same as what the world was before the financial crisis or the world 20 years ago. And as things change, 80/20 Investor does look at that. What will happen if you go to your financial advisor? He will tell you, Damien, this is low risk, because he's always been told that it's low risk because it was when he started, and everyone else defines it like that. But as time goes on, central banks weren't going in and buying loads of these low risk assets 30 years ago, 20 years ago. They just weren't. And so when we get risk on and risk off, when I say that, when people get really excited about markets and they want to suddenly be aggressive and buy stuff, or they suddenly get fearful, what should happen, or historically would have happened in normal markets, is the risky stuff would have reacted first, whereas the stuff at the bottom wouldn't have reacted as much. So think of an earthquake, okay, in a building. The top of the building sways more than the bottom, doesn't it? So that's the risky stuff at the top,
Yeah.
and the low risk at the bottom. What's happening now is actually the bottom part is wobbling sometimes a bit more than the top. That's the world we live in this distorted market. So in answer to Phil's question, it's a brilliant question. It pulls out some real nuances about how the world has changed is that you can use these guides, like I said, the age guide, to give you a starting block, but it may mean that you have to move slightly up the risk scale if you want to acquire potentially the returns you had before. But more importantly, I think the crux of it is you need to readjust your expectations of returns. So what you may have received before on some of the low risk stuff, you might not get now. And equally on the high risk, you have to readjust what your expectations are for the risk you're taking. Brilliant question. And ultimately, 80-20 investor isn't just because I make it, but this sort of stuff is why. It's built in, it's baked in. I spent months building the thing. And it's these nuances that... questions like that are brilliant because they pull it out. And yet I would never mention that on the pod or to people who use the service because... again, it's a nuance, isn't it, of these things, and you almost overlook, but that was integral to it. So, fantastic question, Phil.
Good stuff, and I suppose I best put some sort of input into this podcast today. It is Mount Chimborazo, or Chimborazo. It's in Ecuador. It's 1.5 miles higher than Mount Everest in terms of actual nearest space, if you like, but it isn't the tallest mountain on Earth. So there we go. It's the highest point on Earth.
Yeah, see, that is a good analogy. You know, people who listen to this podcast know I love analogies and comparisons. But yeah, 1.5 miles is pretty significant. If you were stood on Everest and it was next door, and you think, well, 1.5 miles is quite a way up. So yeah, there you go, Andy. Great input, great facts, Andy.
Thanks.
was that off the top of your head?
Sadly not. You know, Google is a man's best friend. It used to be a dog, it's now Google. Right, what have we got coming up next?
I'm conscious of the time, but I'm going to squeeze in 2 quick pieces, almost comments, really. 100% mortgages. Do you remember those, Andy?
Do I remember them? Do I ever? I had one. Yes, indeed.
Did you? The thing was, lots of people had them. I'm not going to sit there and judge anybody. My mortgage, I think, when I took out my house in the early noughties or earlier noughties was 95%. I think
I'm the unluckiest man in Britain because I came along at a time when just before the markets crashed. I did get a 100% mortgage because I didn't have much money at the time, which was brilliant. The market then crashed. I went straight into negative equity. Found myself having to get rid of my property because of various other factors, and now, I can't get any of the help to buy things because I'm not a first-time buyer. I can't get the help to buy ISA because I'm not a first-time buyer. So I've had a mortgage, made absolutely nothing from the property, and now can't get back into the game. So yeah, there we go. That's my hard luck story.
But no, that is exactly what makes this podcast, Andy. Is that real element of, because other podcasts get very preachy, don't they, about life and finances. Me and you are realistic about. I was the same as you. I had a 95%. I probably wouldn't get the mortgage that I had then now because things were very different. Like you said, the market crashed. It was just before the financial crisis, and the one thing I did was I was grateful afterwards that I did it was the repayment mortgage thing. You know, I was talking about the first part about turning it into a function of time. I am a cautious guy by nature. I know some people think quitting your job and doing stuff like this makes me not. I am, trust me. I'm not the most adventurous in that respect. But anyway, the point of all this is the 100% mortgage is back because it kind of got kicked into touch, didn't it? Regulators and everybody didn't like it because of similar stories of people being negative equity.
Yeah, and I even remember the 105% mortgages, Damien.
105%, I mean, that is impressive.
I had a friend who went for 105% mortgage on interest only just before the crash. It was an interesting time.
That's incredible, isn't it? I mean, I remember people telling me around that time, just buy a house, like say 105% because it would be going up, and it was in the absolute bubble, wasn't it? And there were people who did, and they lucked out. They bought a house, turned it over in 6 months, and made big profits. But people thought that was going to last forever. Anyway, the point is, there is now something. The 100% mortgage is back. There is now something called a springboard mortgage. I'm chucking it in there. If you want to know more, go on to moneytothemasses.com. The reason I'm doing this piece, because like I said, our podcast is always evergreen. These things are going to be around the new inventive ways of trying to get people on the property ladder. Essentially what it is that rather than getting a guarantor or mum or dad giving you money or anything like that, these springboard mortgages allow you to use mum and dad's money to get a cheaper mortgage, as if it was like an 80% loan to value, but without them giving up without them giving up rights to their own money. I'll quickly explain it. You can look on the site for more detail. Essentially, Help to Buy, as you said, lots of people didn't fit that criteria. They're quite strict criteria on there, and the rates were about 4% a year anyway. So there's loads of people who didn't fit that criteria. What's happened now is there is a company who started, one of the high street banks has started, I won't name them because there'll probably be others doing similar, and if people listen to this in the future, they just need to go and look up the site and Google. What they're doing is, let's say you've got mum and dad, you go for a mortgage, you want 100% loan to value, so you want a mortgage the same as the price of your property. Mum and dad can put 20% equivalent of that value of that house in a savings account with that bank at the same time. They can't have access for 3 years to it. It's still their money, it's not yours, and they can still get paid interest on it. And at the same time, if you default, they don't lose the money or anything like that if your mum and dad are doing it. But what it does is it allows you to get a mortgage at 100% of the value, but at a rate that's equivalent to 80% loan to value. So you're looking at something like under 3% a year, which is very different to the 4% of the loan to values of those Help to Buy schemes, which aren't really helping many people. So you can see what I mean. It's almost like having a 20% deposit from your parents, but not, because they're still keeping it. And it's an interesting idea, because what will happen is a few years down the line after you started that, so say after the 3 years, mum and dad get their money back because they want to retire and use that to do whatever. You can then remortgage, hopefully, to be able to get a rate that is probably going to be better than the 100% one that's out there at that point. So you might be hopefully your property price has gone up. You may be able to remortgage for a better rate. So interesting concept. It's something new. It's something I've looked at and had discussions with mortgage people, and it's interesting. So anybody out there, first time buyers or whatever, have a look. It may be the answer.
It is. It's really, clever people. That is a really good way to lock away some money, but not lock it away, where mum and dad feel a little bit easier about sort of releasing that cash, knowing that they've still got access to the interest and everything else. Interesting. Okay, the other quick throwaway point was?
The other quick throwaway point was that this week there's been lots about financial... Do you know, one in every 15 seconds there's some financial fraud committed in the UK, which is an incredible stat. I mean, I think we've all been victims of financial fraud. I have. I've had people take money off my cards and things like that. I know you have, Andy. I think that nearly everybody has at some point. But there's something called transfer fraud that is that's come out. There's been a massive thing called a super complaint by which transfer fraud is. Let's just say there's a really good example in the press. A man was buying a property. He had to transfer £10,000 to his solicitor. A fraudster somehow maybe hacked the emails of the solicitor, got wind of this, sent the guy an email that looked like it came from his solicitor, telling him to transfer the 10 grand to the fraudster's bank account. Of course, what happened? The fraudster disappeared into the sunset. The thing is, you're not covered. There is no regulatory cover or anything like that if that happens to you. So that money is gone. It's gone. The banks don't have to pay you back. Because the reason is, when you think about cards, whether it's debit cards or credit cards, you can claim back, can't you? If somebody spends money on your card or something goes wrong or whatever, you can't with transfers because the reason the banks get away with it, they say, well, you agreed to transfer money to that person and went through the whole rigmarole, so you've almost okayed it, which have done a super complaint. And what that means is the industry is now going to have to respond to it. Hopefully it means things will change in the future and we will have cover if something like that happens, because it's a very easy thing to do. I've seen a scam like that unfold to a family member, but they actually spotted it beforehand for a holiday deposit on a holiday villa. So while that's all going on, we don't know what will happen. The tip is, again, is if you're going to do that, the way to avoid it is transfer £1 to that person and then ring up the solicitor who you know and speak to, not the person who sent you an email, and say, did you get that £1? They say yes, and then you transfer the rest of the money. Hindsight is a wonderful thing, but that is one way to avoid it. So anyway, that's enough for this week, because I'm conscious we've gone on, but it's been packed this week.
Good. Okay. Anything left to say?
Nothing, Andy, but goodbye, and on to the next one.
Good. Well, it's been enjoyable. The music's playing. I can hear it in the background. Until next week.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.